Hi, it's Frank from CappThesis. Today we'll be looking at the significance of the S&P's most recent 6-day sell-off. We'll look at an impending buy signal from a very popular technical indicator. And at the end, we're going to dissect the only pattern that truly matters for the stock market. So let's get started. And let's first talk about the long losing streak that just happened. The S&P was just down 6 straight days. As we know, that was the longest losing streak since the very beginning of the year, actually from December 29th to the beginning of January, we had 4 days down. If we go all the way back to the beginning of the big uptrend from the great financial crisis, there have only been 12 prior 6-day losing streaks, not counting overlapping instances. And we really don't have a signal from that because 7 out of 12 times the S&P was higher and the average move was very marginal loss. So we can't really go too much by that, but we do know there have been some losing streaks that happened just over the last 2 years that will give us an idea. But for the most part, the bottom line is this, right? Whether we have short-term sell-offs in the form of long losing streaks or something else, if they occur within the confines of long-term uptrends, we know they lead to buying opportunities. We see the beginning stages of that potentially just over the last few days. Conversely, if they occur in downtrends, they just lead to failed rallies and more selling. And we just have to look at the last 2 years of action to see the difference of both of those, where in 2022, again, losing streaks of at least 4. Clearly, there were more than a handful of them. In 2022, they eventually ended. We saw bounces. Each bounce eventually led to more selling until the 2022 low. Now in 2023, now in 2024, we have had other 4-day losing streaks, as here received from this chart from marketcharts.com. Does a very good job of giving you a chance to screen for things like this. And as we know, the market continues to be higher. And we did have a few of them also from August to October of last year. So we had to wait a little bit longer for that to play out. But for the most part, the long-term uptrend, again, from that 2022 low point remains intact. And that brings us to what's been going on recently where, again, 6 straight down days after a time when the market really was extremely consistently high, gives us an idea of how good it has been. Also, gives us a chance to consider potentially, is this a real change of character like we were talking about last week, or was it really just a real dip that the market participants now have a chance to take advantage of, right? So let's look at this from another angle now. Long-term trends, short-term swings. And this is what we're talking about. We've mentioned this chart before. So this looks again at the action from the beginning of 2022. And the basic premise here is that uptrends are characterized by intermittent upswings being bigger than downswings. And that's what happened again from the 2022 low here. The bigger moves, smaller pullbacks led to the uptrend. In 2022, of course, the opposite was true. Downtrends, the bigger moves were on the downside, with the preceding and following rallies being smaller than the downswings. What does that give us? A bear market. And so that brings us to the current environment where the S&P, of course, is dealing with an uptrend that extended almost 6 months and almost 30%. So this most recent downturn, just a few weeks old, clearly not nearly the size or length of what came before us. That's not really what we're talking about right now. We're more concerned with what happens on the next bounce. Is the next bounce going to be smaller than this downturn? If so, that could create a lower high. If we have the next upswing that's actually bigger than this current decline, what does that give us? New highs, right? So we're going to give us a lot of indication of how strong this is by how this bounce is dealt with. Not about the bounce itself. We knew at some point it was coming. It's how the market views it and what it does with it going forward. So in terms of drawdowns, 2 ways to look at this. Just compare it to what's happened over the last number of months. And of course, these you can't even see that well on a daily chart. And of course, this is really the biggest drawdown that we've seen by far. And I would even call it like the only real dip that the market has experienced. And it kind of lines up with what we saw 3 separate times from last August to October. So we had to take a step back a little bit, consider that this current drawdown, 6%, looks just like the initial stages of the pullback from late July when the ensuing bounce was pretty strong, but again, still less than what we had on the way down, and that caused that lower high. And then two more down legs had to transpire before the actual low was in. Now, if we zoom out a little bit more and look at this from, again, the beginning of 2022, really three major pullbacks along the way, all of them just about considered a correction, right? 8%, 9%, 11%. So from that angle, the current one will be the shortest and the smallest. And with it coming after the longest and the best uptrend, right? Maybe this was just telling us that we actually need more to go to really digest what just happened, right? That's another way of looking at it. And we'll see. Again, all about how this bounce is dealt with. And so the MACD. Now, we talked about this on the way down, how almost all of the sell signals we had since the middle of 2023 didn't play out. In fact, 8 of the last 9 were just whipsaws occurring within uptrends. The only one that did was in August, again, of last year, which happened after 4 failed signals. Right now, coincidence or not, same type of thing happened where we had 4 failed signals, meaning the market continued higher after getting MACD sell signals. This one finally worked, being classified as a successful one now, considering that the S&P did drop 6%. So what now? And one thing we haven't talked about in a long time is a MACD buy signal. And that could actually occur relatively soon if we continue to see some upside follow through. And these are interesting because obviously hasn't occurred that often because the market has been relatively straight up for the better part of a year and a half right now. But also I think it's even more interesting that they tend to work in bull markets and bear markets. And remember from 2022, we have some very sharp bear market rallies, even though they were faded. MACD kind of captured the inflection points very well, as we can see from these blue points here. Same type of thing in 2023. Arguably the best time to buy was after, right when we had that October low, after the third MACD buy signal. So we'll see. Again, is this going to be like the beginning stages of the pullback that we saw from late July to August, where the next bounce fails, or this is going to be a major inflection point? Once again, the dip that everyone was waiting for. If we do get the upside follow through, we'll see that. We'll see the MACD buy signal, and we'll see how much the market can do with it at that stage. So daily price action, again, is going to give us a clue going forward, where we had 6 straight down days, as we know. Also had 6 straight days with the S&P closing below its intraday midpoint. As we talk about a lot, it's just as important as the daily price action itself. Now, one thing that did seem interesting coming out of last week and into this week was that we did have positive breadth for the S&P 500. It's well documented now that other areas did much better than technology. So it's important to realize, though, because it wasn't a full risk off day or even week last week with other areas doing well. And from my perspective, it was really a glaring representation of rotation, of there's still buy interest there, whether it's technology or something else. That would change, of course, if everything fell at once for an extended period of time. That hasn't happened yet. So one thing we're looking for now is just to see the number of new highs start to creep higher, with the market pulling back and everything really pulling back off their highs at least. It's going to take a little bit more time, but there are some percolating underneath their own levels, which, again, if we see more buy-side action, that number will start to tick higher once more. And that's going to be important to see, because one thing that didn't happen during those failed rallies from August and September, we didn't see those new highs get any more above 25 until the turn happened in October into November of last year. So in terms of patterns, that downside break we're looking at almost got there, right? 49.44 would have been the target, got within 10 handles of that. But from this perspective, at least, we still haven't got that first successful bearish pattern, which is, again, getting a downside target acquired. That's important to see going forward. And so the question is, what would a bullish pattern look like if one were to develop from here? Well, I'll tell you what a perfect scenario will look like is this, where we start to rally and we really don't stop until we get back to the highs. You see a pause there, and we see a higher low, and then another attempt at the highs. That would create basically a 2-month bullish pattern and a classic inverse head and shoulders pattern. We know one thing, it's not going to look exactly like this, even if things play out very well, but this is the type of thing that we'll be looking for, where the next rally takes us kind of high, but get a higher low again, so forth and so on. So what if that balance that we're getting right now fails? Well, the current bearish pattern may not work out, but another bigger one may morph like this. And so this would be something that would be, say, textbook, where you rally back up to now a rolling over 50-day moving average, creating that lower high, creating the shoulder of an inverse head and shoulders pattern, and then come back down and test this low and then go back below it. So when you have breaks of strong uptrend like this, the market does have a character change and tries to then detect direction in the form of which pattern is going to actually play out. And that's why we're looking at all sides of these, and over the next few weeks, really, as earnings season heats up and dissipates, some of these patterns actually will materialize, with obviously one side working and the other not. And so big picture, S&P 500 still has a target of 6,100 on it. We're still about 4% above that 4,800 breakout. However, that's not the true pattern that matters. There's actually only one pattern that truly matters right now for the S&P. It's probably not what you're thinking of. It's this, meaning that from the October 2022 low, S&P has gone through a number of different phases, being that we've seen an uptrend extend higher, we've seen a downside break with a pullback that then creates a higher low, and then we see that be repeated now 3 different times. And so currently we want to see the same type of thing. And we talked about this, because this was so substantial, the market has a really big window or really big air pocket to potentially fill and still keep this uptrend intact. So no one wants to see a strong move down to even down here, 4,400 or so. That would be a pretty big move from the high. But in general, that would still keep this in play. In reality, even if we get down there, it's going to take a series of patterns along the way, which we'll be tracking. But if this market is going to continue, we want to continue to see higher lows in whatever form they come in. That's what we got for today. Check out these videos and subscribe, and talk to you next time. Thank you.